Inflation means rise in prices. Also, decline in purchasing power over the period. Excess money supply can cause inflation. Supply shortages and high demand also causes inflation. To manage inflation, one must earn more income. Prices can increase overnight, but income cannot be increased. To manage it, one must invest in securities which gives better income, better returns that beat inflation. Hi and welcome to my channel. In this video, we are going to see some investments that can beat inflation. Shares. This is the best investment to beat inflation in long term, but can seriously underperform in the short term. Mutual funds can be broadly classified into debt, equity, and hybrid. Debt mutual fund can be short duration or short term funds that can be better than fixed deposits but have some interest rate fluctuation risk. Equity mutual funds, again, these are strong long term inflation beaters. Hybrid mutual funds are diversified, have more growth potential than pure debt, but still it is market linked. So the risk and reward level is ranging from low to high. Real estate. This can beat inflation over time, but it is illiquid and heavy cost. Gold and silver. Gold exposure is commonly used as an inflation hedge tool. ETFs have market liquidity and price volatility. Index fund. These are broad equity exposure and have risk less than shares. NPS. They have mix of both equity and debt, so it gives inflation beating potential with controlled risk. Government bonds are low risk, but the returns can be very little. Bank FDs are safe, again, but they barely keep up with the inflation rates. REITs have real estate exposure with liquidity than the direct property. Income and asset values will rise with inflation, but it may not be sufficient. Inflation or capital index bonds are issued by government. They have floating returns. Well, they may be useful when the rates rise, but may not be sufficient. International investments have potential to beat inflation, but they are highly risky. They have currency risk, liquidity risk, economic risk, and so on. And they can underperform very badly compared to domestic investments. How to identify risk capacity? First, we identify goal and fix the time period. Goals can be categorized into fixed periodical income, capital preservation and stable growth, or capital appreciation. When you need fixed periodical income, you go for fixed deposits, bonds, shares of dividend paying companies, debt mutual fund. When you need capital preservation and stable growth, a small portion of shares, then hybrid mutual funds or corporate bonds. When you need capital appreciation with heavy risk, you go for shares, equity mutual funds, and international investments. Then you fix the time period. Time period can be 1 to 3 years, 3 to 5 years, more than 5 years, then less than 1 year, which is emergency fund. Emergency funds may be needed at any time, so they need to be liquid and invest them in low risk funds. 1 to 3 years, they also need to be liquid, but you can take low to moderate risk. 3 to 5 years can take moderate risk. 5 years and more can take higher risk. Then you need to consider your age, income stability, expenses and liabilities, your dependents, what is the emergency fund, your emotions or reactions to volatility, and need for liquidity. At young age, you can take risky investments. Gradually, when you get older, you decrease your risky investments and go for more stable income. Income stability. When it is stable, you can go for long-term steady investment and risky investments. When it is fluctuating, high or unstable, you can go for moderate or conservative approach. When you have high expenses and many dependents, it is better to go for stable income investments and good growth and not take too much risk. Emergency funds need to be liquid, so go for FDs or liquid funds. If you are having enough emergency funds, you can go explore higher risk instruments. Check your emotions or reactions to volatility. If you keep checking portfolio on daily basis and do panic selling, it is better to avoid taking high risk. Take conservative or moderate approach. Check the need for liquidity. If it is high, keep them in liquid debt schemes. So conservative investors choose FD, government securities, RBI bonds, debt mutual funds, dividend shares, gold or silver, then PF or NPS. Moderate investors will have index funds, ETFs, hybrid mutual funds, REITs, PEFs, corporate bonds, real estate, gold and silver exposure. Aggressive investors will have shares, equity mutual funds, international investments, real estate, even crypto. A general allocation for all these types of investors. For conservative, they have 20% of equity, 65% of debt, 10% of gold or silver, and 5% of others. So moderate investors, 50% of equity, 35% of debt, 10% of gold, and 5% of others. And aggressive, 80% of equity, 5% of debt, 10% of gold, and 5% of others. All these asset allocation should be reviewed and rebalanced on a regular basis.